We will start with now this question on balance sheet, on consolidation. This is the first question. Again, this December 2020 was CB, so I have copy pasted this. I can use that exam scenario. However, explaining the question and solving it in examination scenario are two different things. If I solve that in that examination scenario, it will be difficult for you to where to focus, whether to focus on understanding the question or how to use the utility. And that's why I have copied this in PDF and we are solving it in the Excel sheet, which is like your exam scenario. Okay. So everyone, do you have, I mean, by any chance, laptops or something like that in front of you? So try to use that, and we will start with the question, reading that question, and then we'll do this question. I will read it. So this is Exhibit 1. The balance sheet is given for alpha and beta. Property, plant and equipment. There is some note in Exhibit 2 with respect to PP. Investments in equity instruments of Exhibit. The information is given in 2 and 4 with respect to the investments. Then current assets are given, inventories. There is some kind of information in Exhibit 3. Trade receivables, cash and cash equivalents. Then you have equity and liabilities. Then you have non-current liabilities, current liabilities. Pension liabilities, there is some kind of information in Exhibit 5, and then exhibit starts. Now, what you generally do when you do the consolidation question, I will quickly tell you. Okay. So now I will again go back to this accounting entry. What kind of or what type of adjustments you might have to do in the balance sheet that we need to understand. We need to first, now in balance sheet question, what will happen? You can note it down when, if you want, if you would like to. Okay. In balance sheet question, you will be given balance sheet of parent and a subsidiary, just like what we had seen right now. Then in that case, what will happen is you will be given various adjustments below that balance sheet. Those balance sheets were at the reporting date. Balance sheets at reporting date. And you are required to account for acquisition accounting, like this accounting entry. This is on acquisition date. Am I right? In the books of acquirer, that is in consolidated financial statements. So you'll have to find out the date of acquisition and find out and pass this accounting entry. Am I right? Now, when you pass this accounting entry, you will not write down this accounting entry per se in this manner. But what is important for you or for us to do as a part of this question is, you need to calculate, first of all, the net assets of the subsidiary as on the date of acquisition. So let's say this is my timeline. Balance sheets are as on this date. This is the reporting date. Let's say this is the current year. Let's say this may be acquisition date or this may be acquisition date. This is the acquisition date. Or acquisition date may be this. It depends. Correct? In examination, invariably, when you do the consolidation, what you will have to do? Now, let's say this is your standalone financial statements, where you will have non-current assets, where you will have current assets, where you will have non-current liabilities and current liabilities. You will also have equity. You will have here investments in subsidiaries, equity shares. This amount you will analyze, correct? And if this is SOFP of subsidiary. This is SOFP of parent. Then what you are actually doing, this represents this equity. You will replace this net assets. You will replace this net assets in this line. This line gets replaced, and now what happens? CFS of parent. In CFS of parent, what will happen? You will have non-current assets, you will have current assets, you will have non-current liabilities, current liabilities, and you will have equity. Non-current assets, now what you are doing, instead of this line, you are replacing net assets of a subsidiary. So it will have parent plus subsidiary, parent plus subsidiary, liabilities, parent plus subsidiary, parent plus subsidiary. This investment will go off and this equity of a subsidiary will go off. Everybody's with me? Those, if possible for all of you to keep on the videos, keep on. I would like to communicate with you. So this will happen, but important point is this: there is also NCI in this, because if you do not have entire profit share, you will also have NCI parked here, because for subsidiary you will consolidate 100%. You will consolidate 100%. For subsidiary, you will consolidate 100%. But let's say your profit share is only 80%. So out of this net assets, you will have to set aside 20% for these people. So how do you measure this? How do you measure this? Because NCI will be there at the beginning, NCI will be there at the end. Am I right? During this period also, entity will earn certain profits. That profit will get allocated. So here also you will have owners plus NCI. Here also you will have owners plus NCI, non-controlling interest. So whatever is the acquisition date net worth, what is net worth? So this is the balance sheet of subsidiary. This is as on reporting date. As on reporting date. However, I have to calculate what is the fair value as on the date of acquisition and what was the NCI also as on the date of acquisition, because subsequently whatever the profits I will incur during the year post acquisition, some portion will get allocated to them, 20%, and balance will allocated 80% to the owners. Am I right? So subsequently this will keep on changing, and if I analyze this reporting date balance sheet, it provides you with a carrying value of net assets. It provides me the carrying value of net assets. Am I right? It is standalone or separate financial statement. Why would they do the fair value adjustment here? Is it correct? No. Fair value needs to be adjusted in consolidated financial statements only. So these assets and liabilities will be adjusted with fair values only in the CFS, because this entity, subsidiary, have sold their stake to parent. Correct? So the existing shareholders have sold the stake to the parent, shareholders of the parent, and while selling that, they have actually sold the net assets. Am I right? And when they sold the net assets, they will they sell it? Will they sell it at carrying amount? Never. Will you sell your asset at a carrying amount to any third party? If you have an old car, will you sell it at carrying amount? No, you will calculate the fair value of that car with its condition, etc., and then you will sell it at that. Its carrying value might be 0, but you will sell it at some price, let's say 1 lakh, 1,50,000, whatever may be the case. That is the fair value at which subsidiary has sold. So considering that fair value, what is acquisition date net worth? What is acquisition date net worth? We need to find that out. Unless we find that out, we will not be able to find out NCI. So I will not be able to calculate NCI as on the date of acquisition, because this accounting entry has to be passed on the acquisition date, correct? So I'll not be able to find out that. For purchase consideration, I'll have to measure it at fair value, whatever the amount I have given for getting control in that entity. So that I'll have to find out. It will have certain adjustments, and I will also have to find out total fair value of the net assets, so that I will be able to calculate whether this transaction is actually beneficial or detrimental to me. At detrimental in the sense, if it's beneficial, it will be gain. If I have paid additional money, then probably I'm not able to recognize those assets in my balance sheet. So I have classified that as a goodwill. Those are not identifiable intangible assets, so I've classified them as a goodwill. For this accounting entry, I must pass this accounting entry as on the date of acquisition, and subsequently I need to carry forward this on the reporting date. Ultimately, I have to prepare a consolidated balance sheet as on this date, but after providing effect of acquisition date. After providing the effects of acquisition date. Are you with me on this? So we need to calculate the fair values of net assets. Based on the fair values of net assets, you will calculate NCI. You have purchase consideration with you. You will calculate goodwill. Out of 25 marks, there are almost about 15, 12 to 15 marks given for this accounting entry, not for passing this accounting entry, but measurement. You'll have to calculate fair value of net assets. You'll have to calculate the goodwill. You'll have to calculate purchase consideration. You have to calculate NCI. Within this 4-line item itself, you will have 12 to 15 marks. And that's why this accounting entry, as I mentioned, is extremely important. So in examination, every information will be given to calculate each of the parameter given here. And again, most important is deferred tax liability on these adjustments. So these are the 5-line items on which you will have 15 marks, approximately 15 to 16 marks out of 25. If you are able to calculate this, then subsequent things also you'll be able to do it. Then there will be adjustments with respect to, let's say, employee benefits, with respect to financial instruments, with respect to share-based payments. All these adjustments will be there. Impairment, there will be adjustment, impairment of goodwill. All right. So with this, we will start with our question. I will also try and highlight the important ones. Okay. They are given the balance sheet. Now let's start reading this information, and I will give you, after reading, the methodology of, generally I don't prefer it, but in examination, as a technique of examination, it is highly important for us to have technique of solving the question. And generally this type is similar. You will get all these kind of adjustments only. So there is nothing that you will face completely new. All right. Then on 1st October 20x4, Alpha acquired 60 million shares in Beta. So if you see, you can highlight here. Let me find out here. Sorry. हाँ. Not field and sign. So highlighter is here. On 1st October 2024, Alpha acquired 60 million shares. So this is the date of acquisition, 1st October 2024. Let's quickly go and read what is the reporting date. So reporting date will be given at the end. Using information in exhibits 1 to 5, prepare consolidated financial position of Alpha as at 30th September 20x5. So it is just 1 year before. As on the opening date itself, I have acquired the shares in Alpha, shares in Beta. So a year back, Alpha made a cash payment. So how many shares they have acquired? 60 million shares. Out of how many? So it's not given here. So we'll have to go back to this equity and liabilities. Check this. These are $1 shares. You check Beta. $1 shares. These are in thousands. These amounts are in thousands. So there are 80 million shares. These are 80 million shares. It's not written here because it is copy pasted. But if you see the examination, the currency and rounding off is given in the paper. It has not been mistakenly, I have not written it here. But otherwise, these amounts are in thousands. So this is 80 million. 80 million shares of $1. So there are 80 million. Out of that, I have acquired 60 million. So what is the percentage of acquisition? 75%, correct? 75% acquisition. So either you can create a scratch pad and make a note here. So percentage of profit is 60 million shares divided by 80 million shares. That is equivalent to 75%. So you have written it here. If at all required, you will be able to use that information. Alpha made a cash payment of how much? 175 million to the former shareholders. Cash payment, okay? Cash payment. They have made a cash payment. So this is about purchase consideration. Shareholders of Beta on 1st October 20x4. So that is the day when control has been acquired, date of acquisition. Alpha incurred acquisition cost of 5 million. They have also incurred a cost of 5 million. It has been presented as a total cost of 180 million. So where this amount will reflect in the balance sheet of Alpha? Can you tell me, anyone? Can you tell me, anyone? Sonal, Yogesh, Babita, Bhimappa, Aniruddha. Where this 180 million would be, where it would be reflected, you'll have to think about this. If you do not think about this adjustment and you will go with me, then it becomes subsequently difficult. Of course, it will be in the investment section, investments in the equity shares, 180,000. So 180 million. Am I right? So this is 180 million. Condition of purchase agreement was that. So is it correct, first of all? Is it correct?
Yes.
Anyone else? Babita?
So because consideration is in cash, so this acquisition cost is not an issue cost. No?
Correct. So where it has to be go? Where it has to go?
In profit and loss account then.
It
As
should
a
be in profit
transaction
and loss
cost.
account, or it should be accounted as a part of investment.
Sir, in P&L no, because it's a transaction cost.
And Sonal, you are saying it is correctly added to the investment.
Yes.
Now go back to our discussion where you can clearly see where this cost should be accounted for. Where you will find this in purchase consideration discussion, where we had done the purchase consideration. I've also told you, I'll get this in front of you.
It will be as per the
No, not as per the IFRS 9. Have you issued the equity shares? No. See this. Transaction related expenditure immediately transferred to P&L as expenditure. Correct? And that's why I told you this is extremely important. So purchase consideration will consist only cash consideration, deferred consideration, contingent consideration. Both of this will be at a fair value or at a present value. And then issue of equity shares or debt instruments will also be considered as a part of this. Correct? So your issue expenses, where those have been classified as a part of this amount, investment amount, is it correct? It's wrong. You will have to make an adjustment for this amount here. Correct? Now, give me a moment. Condition of purchase agreement was that Alpha would make further cash payment to former shareholders of Beta on 30th September 20x4. This is a contingent consideration now. The amount of further cash payment, it may be deferred payment consideration also. The amount of this further cash payment depends on the performance of the Beta of the 3 years period from 1st October to 30th September 20x7. On 1st October 20x4, the fair value of this conditional payment is 60 million. So fair value they have calculated. So this is contingent payment you have to consider as a part of purchase consideration. Because performance of the Beta in the year ended 30th September 20x5 was below expectation, the fair value of conditional payment has been reduced to 50 million by 30th September 20x5, the balance sheet which we are preparing. Alpha has not made any entries on its own for the financial statements in respect of this conditional payment. It is in the consolidated financial statements they have to give effect now. It is not given in the standalone financial statements. Ideally, it should be given, but they have not given it. On 1st of October 20x4, Beta has retained earnings. Date of acquisition, retained earnings were 80 million and other components of equity are 45 million. On 1st October 20x4, the fair values of the Beta's identifiable assets were same as their carrying amounts in the individual financial statements of Beta, with exception of property, plant and equipment, which had a carrying value of 150 million and a fair value of 205 million. On 1st October 20x4, the useful life of the property, plant and equipment was 5 years. The fair value adjustment should be regarded as temporary differences for the purpose of computing deferred taxes. The relevant rate of income tax to use this purpose is 20%. For deferred tax, you will also have to calculate for this fair value. So now you tell me one thing. When I was talking about this, about our discussion on this has to be fair value, etc. I will bring you here. I was talking about this has to be at a fair value, etc. Correct? As on the date of acquisition, it has to be fair value. Now you tell me, in this example, have you given the acquisition date carrying value of fixed assets? In this example, have you given acquisition date carrying value of fixed assets?
Yes.
Where it is given?
150 million.
But then you tell me, what about others? How I will have to consider, and if I have to consider the fair value effect, where I will give the fair value effect. So you are right, it is given 150 million. But line by line, do I know where is the and how the fair value has been increased? Answer is no. Now, if I would like to find out the net worth, where the other assets, where the carrying value is equivalent to fair value, do you know that amount? Now, if you see here, I need to calculate net worth. I need to calculate the net worth as on this date, correct? This is a net worth as on acquisition date. What is net worth? Net worth is net assets, correct? Net worth is fair value of net assets. Am I right? Fair value of net assets. I should know fair value of all the assets and liabilities. Then only I will be able to understand the net worth. Am I right, Aniruddha? But
Yes.
here you know the fair value of only those assets where carrying value is different. But for those assets whose carrying value is not given, how will you consider those assets and liabilities so that you calculate the full net worth? That's a problem, right? This will be in every problem, this will be the question. But answer to this is very simple. What you have to do is fair value of net, let's say carrying value of these net assets is equivalent to equity, carrying value of equity. Am I right? Carrying value of net assets is equivalent to the carrying amount of equity. Am I right? As simple as that. Any balance sheet you take, add up all assets, reduce all the liabilities equivalent to your equity, because balance sheet has two sides, must be tallied. So it's a simple math which you can understand. So carrying value of net asset in the example, it's given by this way. Retained earnings is 80 million. Other components of equity is 45 million. And share capital is also given. Share capital is also 80 million. That has not been changed. Correct? So your equity is given for the beta, which if that gets adjusted with the fair value adjustment, you get the fair value as on the date of acquisition. Am I right?
Yes.
That's the simple way of calculating the net worth as on the date of acquisition. Otherwise, you will find this kind of a query, or you will have this kind of a question always. Why this type of information is given? Fair value. Why we utilize the information provided? This is the information provided about acquirees equity as on the date of acquisition. Why that information is given? It's because you will be able to calculate the net worth, because this 80 million plus this 45 million plus this 80 million as a share capital will be equivalent to your total carrying value of net assets. If that carrying value of net assets, if adjusted for the fair value, then you get the fair value of net assets as on the date of acquisition, which is what we require. Are you getting my point? Simple. Now, directors of Alpha remeasure the non-controlling interest at its fair value. So you know fair value, how to calculate the fair value of the equity share. And they have given that fair value. You need not even calculate. On 1st October 2024, the fair value of the non-controlling interest was $65 million. You don't have to calculate. So there are no marks for NCI fair value calculation. Second adjustment entry. Intra-group trading. Since October 1st, 2024, Beta has been supplying Alpha with the product. Beta is supplying Alpha with the product. Beta earns a margin of 25% on its product. On September 20x5, the inventories of Alpha included 20 million. Inventories of Alpha included 20 million in respect of the product. There were no outstanding intra-group balances as at 30th September 20x5. So this 20 million is with respect to inventory. You will have to consider it elimination of unrealized profit on it. Correct? Impairment review. Alpha undertook impairment review of its investments in Beta as at 30th September 20x5. Beta comprises of 3 cash generating units for the impairment review purposes. Relevant details are given. So Beta has 3 cash generating units, A, B, C, percentage of goodwill. So it's very clear that there will be goodwill on acquisition. So as by default, if there is an information of impairment of goodwill, So there is clear-cut information with you that there is a goodwill. Am I right? So you don't have to think much about it, whether there will be gain on bargain purchase or goodwill. It's clearly given in the example that is goodwill. Goodwill is allocable on CGUs in this ratio 40:35:25. Net assets will also be there. What is given to you is recoverable amount is given to you. Recoverable amount as on 30th September 2025. You have to compare this recoverable amount with carrying value along with goodwill. So you have two jobs on your hand. Number one, calculate the amount of goodwill, allocate in this ratio 40:30:25. And second most important job is calculate assets, net assets as on 30th September 2025. Calculate carrying value of net assets of beta as on 30th September 2025. Allocate that in the ratio along with goodwill, calculate their total carrying value, compare it with this recoverable value, determine if there is any impairment, and if there is an impairment, allocate that loss and account for that loss. Are you getting my point here? This
Yes, sir.
is very much important adjustment. This is most important adjustment. Then retirement plan, last adjustment. Alpha established a defined benefit retirement plan for its current and former employees. Beta has not established such plan. Statement of financial position of Alpha. So this is an external plan. Okay. So Alpha has established such plan. There is no such plan of Beta. So where you will get this information? You can get this from a balance sheet. If you see pension liability, you can see only for Alpha. You will not see anything for Beta. So there is no such plan for Beta. That's okay. You don't have to create it on your own. Okay. You don't have to do it. The statement of financial position of Alpha in Exhibit 1 shows that the net defined pension liability as at 30th September 2024. This is a net defined benefit liability which is given here. In the balance sheet which is given, it's a net defined benefit pension liability. It's after considering the contributions to the plan assets. So this is net liability. During the year ended 30th September, Alpha made payments of 30th million to the plan. So plan assets contribution is 30th million. However, while making this payment, Alpha debited retained earnings by mistake. Is it correct? Debiting retained earnings for the contribution to plan. Will you debit it to profit and loss account when you contribute to profit to the planned assets? You are on mute, Babita.
No, sir.
So you are creating asset that cannot go and sit in the profit and loss account. Are you getting my point? And that's why you will have to rectify this first in the books of Alpha and then treat it correctly and find out the closing balance and accordingly find out the actual gains and losses. So this is only accounting entry that has been made for the year ended 30th September 2025. Current service cost is given 25 million. Net interest cost is given 2.5 million. On 30th September 2025, the defined benefit pension liability was 160 million and plan assets fair value was 105 million. So you will have to calculate again net if you would like to compare it with the opening balance, and then you will have to account for it accordingly. You are required to prepare consolidated financial statements, consolidated financial position of Alpha at 30th September 2025. Okay. Unless specifically referred in exhibit, you should ignore deferred tax. Unless specifically mentioned in the exhibit. So intra-group trading company, intra-group trading balances or elimination of unrealized profit will have effect of deferred taxes. However, we will not consider it because that specific exhibit has not required us to calculate the deferred taxes. However, this fair valuation on acquisition, we are required to calculate the deferred taxes because they have specifically mentioned that. Correct? Using this, we are required to prepare the balance sheet. Now, generally, what you need to do, once you read this question, highlight the important things think on what is to be done. You, first of all, I always say there has to be kind of a methodology which should be drawn up. What is to be done? I will write it here. Approach to balance sheet question. Even though this is a broad outline, it may vary. It may vary question to question. This is important. Okay. What the first thing which you should do is first read the question. Read the question and highlight the important adjustments. Highlight the important adjustments. Second, you need to prepare a structure for balance sheet. Prepare a structure for SOFP. Prepare a structure for SOFP, and from question, post amounts in the balance sheet or in working notes. So whatever the question is given, so we have got this question in front of us. This question is in front of us. First of all, we will prepare structure for the consolidated balance sheets. Prepare a structure for consolidated, for consolidated SOFP. Consolidated SOFP. And now, as you have highlighted, pass these amounts consolidated manner, either in balance sheet phase, which you have prepared a structure, or to the working notes. So that would actually be the third part. Prepare this thing, structure, then prepare working notes. Prepare working notes. Which working notes are important and which always will be there? Number one, analysis of profits of subsidiary as on date of acquisition and as on reporting date. This is the most important one. Then second, calculation of goodwill. You must, any question comes on the balance sheet, you will have to do this calculation, goodwill or gain on bargain purchase. Or gain on bargain purchase. Then you will have to calculate NCI. NCI, this is as on the reporting date you would like to have. Next, you will have retained earnings of parent. Retained earnings of parent. And last, if it is there, other components of equity or other equity, if there is any. In our question we have that other equity of parent. You must prepare this 5 adjustments, 5 working notes. These are the most important ones. These will be there irrespective of any question. It may change, it may vary from time to time, but generally these will be there. Now, fourth one is from question post the amounts in balance sheet and in working notes. So whatever working notes you have prepared, post those amounts in the balance sheet or working notes. Then read the adjustment and account for it. Account for in SOFP and in working notes and close the balance sheet. Close working notes and then SOFP. These are broad 6 kind of a steps, I would say, you will have to follow in the balance sheet question. We'll go one by one. So first of all, now we will prepare the structure of balance sheet. Books of alpha, statement of consolidated SOFP as on 30th September 20x5. What you will have in balance sheet, first of all, assets, you will have note number, you will have amount. These amounts are in USD 1000. In assets, you will have non-current assets. What you have already, you can write it down immediately. You have property, plant and equipment. Investments will go up, so you do not write the investments in equity shares of instruments. If there are any other, you can write, but there is goodwill also. We know that there will be goodwill in consolidated financial statements. Then you have, leave couple of spaces blank and then go for the current assets. Current assets, you have inventories, you have trade receivables, and at the same time, if you would like to, you have read the adjustments and you know where there is adjustment, where there is no adjustment. So PP, we have adjustment, so we will make an working note for that. Goodwill, there will be a working note, definitely we are going to do that. Inventories, there is only one adjustment with respect to elimination of unrealized profit on it, so we will do it here itself. Trade receivables, there is no adjustment we had seen because there are no intercompany payables or receivables which they have mentioned. Then we have cash and cash equivalents. You can pass the immediately amounts, but generally once you prepare the format and working notes, then pass the entries. So everything is covered at that point of time. Leaves few places blank and then you start with equity and liabilities. Equity and liabilities. Here, first equity. In equity, you have share capital. Then you have retained earnings. Then you have other components of equity. For the all this, you will have a working note. There will also be NCI in this case, correct? Non-controlling interest you will have. Keep one or two places blank and then go for the liabilities. Sorry. go for non-current liabilities. Non-current liabilities, there are long-term borrowings. Then you have deferred taxes. Then you have pension liability. Leave couple of places blank and go for the current liabilities. Current liabilities, you have trade and other payables. Then current tax liability. Then the current tax liability. This is how you will make the structure first, okay? And then we will first pass on these amounts. We will get rid of this entire balance sheet which they have given. We will get rid of this entire balance sheet. We will pass this entry wherever it is required to the respective section. So before that, we need to prepare then the working notes. So working notes. Working notes. First working note which we need to prepare. I've told you analysis of profits of beta. Here there are two dates. One is date of acquisition, and here is date of reporting. Date of acquisition. So this is the first working note. It will require some space because we have to allocate the net worth related items first. Then as on the date of reporting, difference between that will be post acquisition gains and losses. Those will be allocated between owners and NCI. So for that we will require some space. So keep some spaces or lines blank. And then go for the second one. What is the second note we talked about? Calculation of goodwill. This will have adjustments in purchase consideration, impairment of goodwill related adjustments. So again, we will require some space here. Then go for the third, calculation of non-controlling interest. Calculation of non-controlling interest. It may not require that many spaces, only 3-4 as such. Fourth is retained earnings of alpha. And last is other components of equity of alpha. We any which ways are not going to calculate this for the beta because that gets subsumed as a part of net worth itself. So we will not do anything for that. We have adjustment in, let's say, there are not many adjustments here. Let's say sixth one is property, plant and equipment. We have some adjustment there. There is exhibit given for that. Then as and when, so there is a calculation of impairment and a pension liability. So these two adjustments are there. So we will also create that. Goodwill impairment adjustment. Goodwill impairment adjustment. You will require some space here. And then you will pension liability, right? Pension liability. Pension liability calculation. These are the 8. If you see here, we have highlighted, we have read it. So intra-group adjustments will be accounted directly in the inventory and profitability. Impairment, we have created the separate working note, and for retirement benefit plans, we have made the separate working note. So chronologically, we have made all the adjustments. Now what we have to do is get rid of the balance sheet which is given here. So we will account for this. Now there is a separate working note for this. So I'll go to the working note of property, plant and equipment. I will write here alpha plus beta equal to 2,50,000 plus 1,70,000, 4,20,000. So these columns we will align it for the numbers per se. Alpha plus beta. See, you don't have to do addition on the calculator. Even if you do it here in Excel, it saves a lot of your time. Then investments in equity instruments. You have to do something for this amount, right? Where this will go, where this will be used, where this amount will be used. Aniruddha, Yogesh, or Babita.
For calculation of goodwill.
Calculation of goodwill, absolutely right. So here there is a calculation of goodwill. This working note is there. So we will write purchase consideration. What is the purchase consideration here is 1,80,000. You are accounted for that. There are adjustments. We will do it subsequently, not immediately. Okay. Now inventories. Inventories, if there are not many adjustments, you will write it here itself. Inventories. It's here. How much is that amount? 80,000 plus 60,000. And you will keep some space for adjustment of unrealized profit. You'll write it here. 1,40,000. Whatever the adjustment is there, once we write the adjustment here, we'll immediately make the entry in the outer column of the amount. Then trade receivables. Trade receivables, there is no entry, so you can write directly as 90 plus 55. Then you have cash and cash equivalents. No accounting entry is equal to 30 plus 25. Even if you do this, examiner will be able to understand whatever you have written it here. Correct? So don't write directly 55,000 by doing it on a calculator. So it's our calculator itself. So asset side is over. We have utilized it completely. Then go to the equity and liability side. Share capital of these beta, where it will go. First of all, alpha will write. So share capital in share capital. We will not add share capital of beta here. Of course, we will not. Okay. Then retained earnings, we have a separate working notes for these two, retained earnings and other components. Go to that. Retained earnings. So this is 1,50,000 and other components of equity is 60,000. Then you have for these beta. So for beta, you have made a first accounting entry. Share capital, a first working note, sorry. First working note, share capital. As on the date of reporting, share capital is 80,000. Then retained earnings. Retained earnings. It will be as on the date of reporting, it is 85,000. It's given here. Other components of equity are 45,000. Other components of equity 45,000. So you have used all these amounts. Go ahead and use NCL, non-current liabilities. Non-current liabilities, you can write it directly because there is no adjustment, it seems. So it is 90 plus 15. Deferred taxes 20,000 plus 15,000. There will be adjustment here. there will be adjustment here. So you can note it down for 20,000 plus 15,000 plus whatever it is. You will keep this space. Then pension liability, there is a 50,000. We have working note for this. Go to that working note, pension liability, opening balance, 50,000. Trade and other payables and current tax payable, no adjustments it seems here. You can directly trade and other payables, 70 plus 50. Current tax payable is 30 plus 20, 50,000. You have used entire balance sheet, am I right? Where it was required, wherever it was required, we have posted those amounts. Now start reading the adjustment and start posting it. On 1st October 2024, Alpha acquired 60 million shares of Beta. So we utilized this information and calculated that there is 75% of a stake which is acquired. So NCI is 25%. Alpha made a cash payment of 175 and also included transaction cost in that, which is wrong. So what I have to do is purchase consideration, in this case 1,80,000, I have to reduce from here. Acquisition cost wrongly included as PC, as a purchase consideration. That 5,000 you will have to reduce, negative 5,000. Okay, you will have to reduce that purchase consideration. So accordingly, your purchase consideration, cash purchase consideration, cash purchase consideration will be 1,75,000. Where the second effect will go, balance sheet will have one effect, providing the you'll have to post that balance sheet, but adjustment will have two effects. As always, adjustments, because it's a double entry bookkeeping system. If we are correcting here where somewhere it has gone wrong, that also we have to correct. Where the second impact would have gone,
Retained earnings.
retained earnings, they have debited it. So what has happened here for 5 millions? They have, ideally they should have transferred to retained earnings, but they have not done it. So I'll have to transfer it to retained earnings. So retained earnings, I have a separate working note number 4 for that. Less correct accounting of transaction cost. This will be reduced. So you can otherwise give reference also. So if you give reference, it becomes easier for examiner to understand how you are navigating. Subsequent information, conditional payment. That conditional payment is payable on 30th September 2027. After how many years? After 4 years of acquisition. That is after, still after 2 years. We are on 20x5. After 2 years, it is payable. So we have not created any kind of a liability for that. There is no liability. Have you seen any liability for this? No. On 1st October, the fair value of conditional payment was 60 million. Because performance of the beta was degraded, the fair value became 50 million instead of 60 million. Alpha has not made any accounting entries. So we'll have to make accounting entries here. Am I right? Where you will make the accounting entries for this? First accounting entry, 60 million. First of all, we need to adjust my purchase consideration. Add fair value of contingent consideration. Fair value of contingent consideration, 60 million, so 60,000. Always remember your adjustments will be given in millions. The amount which have been mentioned as a million. But if you see here, these are in thousands. So that's again one more confusion. So make it a clear point on your mind while you are solving this. Where the second impact would be. Sonal, you are on mute.
So we have to create provision for it.
Provision, liability, right?
Liability, yes.
It's a liability. So liability is here. Contingent consideration. But this contingent consideration may change. Currently, it is 60,000. Currently, it is 60,000 as on the date of acquisition. But 20x5, they have changed it to 50 million. But first of all, I need to give effect for first the 60 million. So I completed the transaction. Are you with me? So one effect I provided for the 60 million in purchase consideration, and the second effect I've provided in the liability. I've created a liability for that. Now subsequent information is also important because that is the balance sheet date. So balance sheet date, that contingent consideration has actually reduced to 60,000. So 50,000. So I'll reduce 10,000 from here. My liability has been reduced. But there, where the impact of this should go? Fair valuation of a contingent consideration. Where it should go? You have adjusted this balance sheet. Earlier it was 60,000. It is write back of a liability. Logically, where it should go? Mansi, I cannot hear you. Yeah, Yogesh.
Return earnings, sir.
Retained earnings. Remember this, I've told you, I have also told you how can people make adjustments in practice also. They can increase contingent consideration and subsequently they will also reverse it back. So reversal of liability will have impact positively in P&L. So to curb this kind of practices, goodwill should also be tested for impairment if this happens. So second impact of reduction, first impact what was? Creating a liability for contingent consideration which was not provided. So I have included it as a part of purchase consideration for calculating goodwill. Second impact I provided, I created a liability for 60,000, but then subsequently I reduced it because fair value was changed after acquisition date on subsequent reporting date. Every year it has to be fair value. So that reduction I'll have to account it in the retained earnings. My profits will increase because of that. Reversal of contingent consideration. It has a positive impact on this. It's a positive impact on this. Are you with me? So you can actually give reference here less. So this, instead of writing it, sorry. Less you can provide. So liability is reduced. So you can give impact from this thing. So your two effects are given. For this paragraph is over. Are you with me, everyone? Any questions on this? Now next paragraph. On 1st October 2024, Beta had a retained earnings of 80 million. So as on the date of acquisition, they have given it. Where we have created this, it's here. Share capital is not given. It means it will remain same. So we will write the same thing. It's not given. It is unchanged. If no information is given, it is unchanged. So I have kept it same. Retained earnings are 80 million. So 80,000. And other components of equity are 45 million, 45,000. Correct? Everybody agrees? So now as on the date of acquisition, I've got cost, carrying value of the net assets. These are the carrying value of net assets. Am I right? Everyone. These are the carrying value of the net assets, correct? So I have to adjust this carrying value of net assets with its fair value information so that I will get as on the date of acquisition I will get the fair value of my net assets. Am I right? So now subsequently that information has been given. On 1st October 2024, fair values of the beta are equivalent to their carrying amounts. So these are mostly the same. This is nothing but net assets. So carrying value of all assets minus liabilities is the equity. That's the carrying value. Except for some assets. So I'll have to do that adjustment. Adjustment for fair value of property, plant and equipment. What is that? So carrying value is 205 minus 150 million. It is 55 million positive. Are you getting my point? So the carrying value of assets having 150 million as a carrying value, the fair value is 205 million. So I have already considered 150 million as a carrying value as a part of this net assets. Am I right? So I have to adjust fair value only to get the fair value of the net assets. Am I making sense here? So I have adjusted this, but immediately I'll have to consider the deferred tax impact on this. This will create deferred tax liability. Am I right? So deferred tax liability on fair value effect. What is the deferred tax percentage? 20%. So I'll have to consider 20% of this liability. This is increase in the fair value. So your tax base is lower. So liability is negative. So if this is a positive impact, this will have a negative impact. So it is negative. So you'll have to consider the signs also. Correct? Now, the same assets have useful life of how many years? 5 years. Am I right? So as on the date of reporting, also whatever I have from the standalone financial statements, I have carrying amount of net assets as on the date of reporting. But in CFS, I should consider fair value of those. Am I right? So how do I consider fair value of those? So I should also take this impact for the subsequent year, but after depreciation. If 55,000 has been added as a part of this as an asset, I should also consider depreciation on it. So that's why this 55,000 divided by 5. Sorry, this 55,000 minus depreciation on this. Depreciation, how will calculate this 55,000 divided by 5? It will be 44,000. And you will also have to consider the deferred tax liability again subsequent year. So difference between these two will be considered as the deferred tax reversal of the deferred tax liability. So the deferred tax liability will now reverse. So if you calculate this, it will be 8,800. It will reverse by that amount. Am I right? The effect of this 2,200 reduction of this, what is the amount of reduction? Sorry. Is 2,200, where you should take this to deferred tax liability. This effect should be taken to the deferred tax liability. So second effects are still remaining, but second effect of this asset should go to the property, plant and equipment immediately first. So we have this working note prepared. So add fair value as on the reporting date, fair value adjustment as on reporting date. As on reporting date, how much is that amount? You will have to add this amount to this. Otherwise, you will be adding only in the net worth. That is not correct. So here you will have to consider it. Am I right? Deferred tax liability on this. This amount should be added in the deferred tax liability. that amount already is in negative. So we need to add that amount. $2,200. Here you will have to adjust that. You need to add that, correct? This amount. 8,800, not 2,200. I'm sorry. 8,800. This was not at all accounted for here. So it will be 8,800. Your total balance should be 43,800. Are you with me, everyone? It's not the difference. The difference you must have accounted for in the current year. If you are preparing full-fledged financial statement, you have already created the balance in the system. So you'll give impact of 2,200 as a reversal of deferred tax liability, and amount will be 8,800. But in balance sheet, that effect was not given at all. So you have given that effect now. All right. So next. Give me a moment. It's giving me troubles. Mouse is giving me some trouble. Okay. Intra-group trading. Now in intra-group trading, there is cancellation of unrealized profit. Can we do it immediately? Yes. In whose inventories it is, doesn't make any difference, to be honest. It is currently in the books of Alpha, but inventories you have consolidated together. Am I right? So whatever is the unrealized profit, you will have to reduce it from the inventory. However, you have to be careful while you are eliminating that from a profitability. From whose profit it should be eliminated? Beta, because beta has made that profit, not alpha. Correct? So you will have to account for here. So first elimination, how much is the amount? 25% on the product. So how much costing is there in the alpha's inventory? It's $20 million as of now. So this is 125%. So this includes profit. So if you have to remove this, so this has to be divided by 125%. What is that amount? 20 million divided by 125% will give you 100% amount. What is that? 16,000, correct? So 4,000 is unrealized profit, correct? So 4,000 is unrealized profit. Reduce it from first inventories. Okay, so this is inventory. Inventory will be 1,36,000 ultimately, and then second effect. Where the second effect will go?
So beta profit will get reduced by 4,000.
Correct, but where beta profits are showing currently?
At the date of reporting profit, retained
Correct.
earnings, sorry.
Retained earnings, but this retained earnings, I've clearly mentioned it is of alpha.
No, above working.
In the analysis of
Analysis of
Yes.
profits of beta.
This is important for us. Beta profit are included here. So whatever is the distribution, we are doing it here. So less unrealized profit on inventory. Less 4,000. You can also do the adjustment of deferred tax here at the rate 20%, but they have clearly mentioned if it is not given in the exhibit, you can ignore. If you calculate, you will get marks. I mean, not at extra marks, but you can calculate here if you would like to. So 4,000 multiplied by 20%, 800. You can create additional deferred tax asset in this case, and that asset will be adjusted against this liability in the deferred taxes. So it will be 43,000 only. So that liability will be reduced by asset. But if they have clearly said ignore it, we will ignore it. If you would like to consider, you can consider. Okay. Or if any other questions, similar type of question comes, then you may consider deferred tax asset here, because you are eliminating profit. So you will have to create deferred tax asset in that case. Are you getting my point? We had seen this, and this will be adjusted in the net deferred tax liability. So that will be 43,000. All right. Subsequent adjustment. So we have done with this exhibit 3. Now exhibit 4. Alpha undertook an impairment review. Now impairment review and retirement benefit plan are the only two adjustments which has nothing to do with acquisition date accounting, or in the books of beta it has nothing to do with it. So we'll have to straight away and immediately take the totals of this, because we need it from impairment perspective for goodwill calculation, because unless and until we will not calculate this, we will not be able to complete the question, or will not be able to use this exhibit 4 information for subsequent and further adjustments. So this 249 is the acquisition date fair values of the net assets, where this information will go. There is one information we have forgot to use. This
NCA fair value.
Yeah, NCI is at fair value. We have not used it. We can post here. $65,000. NCI is 65,000 here. The second impact of that will be in this add. Add NCI at fair value. My total consideration is this, my NCI is this. This plus this is 300,000, out of which I will reduce my less fair value of net assets. It is given in working note number 1. I will use directly that amount, 249. So this will give me my goodwill. 3 minus this 249. This is goodwill before impairment. So this is goodwill before impairment. I'll also have to calculate impairment. So I will go to that working note on goodwill impairment. Goodwill impairment, I need to first allocate the carrying value of the assets. Carrying value of assets as on 30th September, because impairment exercise has been done on 30th September 2000 X5. So there are 3 CGUs. A, I have B, I have C. I have 3 CGUs, and for these 3 CGUs, the proportion of the asset is given here. It is 40%, it is 35%, and it is how much? 25%. 25%. I will have to change the number format to percentage. It will give this, correct? So first of all, I need to find out the carrying values as on 30th September. What is the total carrying amount? This amount. This is as on the reporting date. net worth or the carrying value for consolidated financial statements as on the date of reporting is this 241,200. This I will have to allocate in this ratio. So this is multiplied by. So we'll have to calculate this for all three sales. Total should be 241,200. Then you have to allocate goodwill, add allocable goodwill. Allocable goodwill. What is the total goodwill? Again, it is given in working note. This 51,000 is a total goodwill here. Allocable goodwill. You will also allocate this. This is the goodwill 51,000. What is total carrying amount of the CGU? This is the carrying amount of CGU. Total carrying value of CGU. You also have been given recoverable value. Recoverable value, which is provided here. Take this 100,000, then 110,000, and it is 80,000. Where it is impairment? Can you tell me if there is impairment, where it is impairment? Where is the impairment loss? Yeah, Deepali. Sorry?
In A.
A or C?
A.
Okay. Where your carrying value exceeds your recoverable value, you need to bring down the carrying value to the recoverable value. So 16,880 is the impairment loss. Others, there is no loss. Where carrying value is actually less than the recoverable value. So this recoverable value is higher, and that's why there is no impairment loss. Correct? So impairment loss is of 16,880. Now this impairment loss is with respect to investment in beta. So it needs to be allocated to a parent and NCI both. Am I right? So you have to consider this for allocation. Allocated impairment loss to parent 75% and NCI 25%. This multiplied by 75% multiplied by 25%. Total is 16,880. There is a pension liability calculation immediately behind that. Now, what below that? What and where these amounts will be transferred? Where you will transfer these amounts? Where you will transfer these amounts? Some kind of a hint?
For parents, against that goodwill, what we have created.
Parents?
In case of parent, sorry.
In case of parent, where it will be transferred, and in case of NCI, where it will be transferred? It's very simple, na? This has to go to retained earnings with respect to parent. This has to go to NCI.
NCI.
Simple. So go to this working note, say less impairment loss on goodwill, working note number whatever. So we'll have to write the working notes where we have not written the working notes, but equal to, this is minus This is with respect to parent. And in NCI, you have calculated NCI here. Impairment loss. You have utilized this information. One more information we have to utilize is, so we have to also have second impact on goodwill. Less impairment loss you'll have to consider this. What kind of an accounting entry you will pass? You will first write down entire goodwill. So debit goodwill, debit your profit and loss account, credit goodwill. Am I right? So P&L you have accounted for first. P&L of parent, P&L of NCI, you have given effect there. Second is goodwill. So second credit you will have to do it here. So this is goodwill. Goodwill as on reporting date. Okay, so this amount you will have to go and immediately park it here, goodwill. Otherwise, we'll pass it on at a later point of time. Let's do one more thing. Now, on note number 1, if you see, this is the date of acquisition information 249, and as on the date of reporting is 241, 200. So is it a loss or gain as on the after acquisition? Net worth as on the date of acquisition is 241, but as on the reporting date it is 241, 200. Is it loss or it is gain? Post acquisition, your net worth is reducing or increasing? I'm not asking any complicated
Reducing.
question, right?
Reducing.
It reduced, so it's a loss. I have a loss on this. Post acquisition loss. Post acquisition loss of beta, that has to be accounted for, allocated to parent 75%, allocated to NCI 25%, multiplied by 75%, multiplied by 25%. This has to be allocated to parent and NCI. This is important fact. We'll have to consider this. Where it will go? Where it will go?
Parents retain earning and NCA to NCA working.
Correct. So I will take this to parents retained earnings. Working note number 4. Share of post acquisition loss. This, and other amount is to the NCI. Correct. So you have passed these accounting entries till now. Now pension benefit, last adjustment. Now what we have to do here is, we have written already the pension amount, pension liability. What is not considered here is contribution to the planned asset. Now we are calculating net, so we also have to consider less contribution to plan assets. So this amount, from where actually you have accounted for, this amount in the, so let's say read this. So during 30th September 20x5, Alpha made a contribution of 30 million to the plan. While making this payment, Alpha debited retained earnings. So debiting retained earnings by 30 million, is it correct? No. So I'll have to reduce it first from here. So the whatever is retained earnings being debited, I have to negate that impact. So retained earnings of 1,50,000 includes cost of 30,000 that I should actually add back. So add back reversal of contribution to plan assets wrongly debited to retained earnings. How much is that amount? I have to add it back. 30,000. My retained earnings will increase to that extent. Same effect I'll have to give it in this. My liability will reduce. Net liability will reduce because of this. Correct? Net liability will reduce. Otherwise, contribution to plan does not have impact on liability per se. We had discussed that earlier. However, when we are calculating net, that will have impact of reducing the liability, because assets will increase on assets will reduce the net liability. So I have reduced it from the pension liability. Are you with me, everyone? Two impacts are given for one wrong adjustment. Next, now the current service cost is 25,000 and interest cost is 2.5. So I have to also account for in the pension plan. Add current service cost, it's 25,000 and interest cost is 2,500 and interest cost is 2,500. Where this impact should go? They have not passed any entry. They said the only entry they have passed is the wrong accounting entry of contribution to plan assets as a debit to retained earnings. So we have rectified that, and this has not been passed at all. So where this will go?
Reduce retained earnings.
Retained
Earnings. In retained earnings, less current service cost, my retained earnings will reduce interest cost on pension liability. I will reduce this from retained earnings, this amount, and 2,500. So I have provided two effects. Now, last few things. They have said that on 30th September 20x5, the defined benefit pension liability was $160 million. So this was liability, and assets were 105. So I have a closing balance of this pension liability. I can check what is this amount. I will have closing balance of net defined liability. It is given 160,000 minus 105,000. 55,000 is my closing liability. And as per my calculation, this is my closing liability. But then there is a difference. What should be the difference?
Actuarial gain loss.
actual gain loss. Everybody agrees now here it is loss or gain. This is the reconciliation we are doing. Opening balance
Loss.
at
Loss.
loss, because after in opening balance sheet, after adjusting the contributions to plan, current service cost, interest cost, I get this liability, but my liability is more, it means there is loss. So this is the actual loss. Balancing amount. This where we should account for this second effect of this.
Other components of equity.
Other components of equity. Other components of equity. Go to other components of equity. Less actual loss. Minus 7,500 here. Correct? This is an actual loss. Now, this pension liability should also, now all balances should now be transferred to the balance sheet. So now let's go one by one. PP, we have note for goodwill, we have note. So let's say goodwill first. We'll also write the note number here. So equal to, we will write closing balance of the goodwill. It is in note number 2, 34,120. So we will write the note number 2. PP, we will write PP closing balance. We have a, now this, we have not made a total of it, but let's do it. This is note number 6. This is note number 6. Sorry. Then inventories you have done, adjustment is also done for that. Trade receivables, cash and cash equivalent, there is no effect or there are no adjustments. Your total assets should be this plus this. Now, retained earnings. We'll have to go to the retained earnings. Retained earnings is note number 4. I don't know if we have totaled it or not. Note number 2 is the retained earnings. Other components, no, not note number 2. I think note number 4 we have. And other components is note number 5. Let's go to the retained earnings. Let's total it. Then you have other components of equity. Then you have NCI below that. NCI. NCI, we have note number, I think 4 or no, 3. 3 is NCI. $58,830. Let's see about. We have done all this. Pension liability you have to write. Pension liability note number is I think 8. This is the pension liability. Now pray to the God that this should be equal to your total assets. If not, then I will have to find out what and where we have gone wrong. But it's not wrong. This is total assets. And this is total equity and liabilities. Finally, we have been able to complete the question. We've started at 11:30. It's almost 1:39. But for first half an hour, we didn't speak about the question at all. I was just giving you the overview of what is the website of ACCA looks like, what you should do, what you should not do, etc. So considering this, we have taken about 1 hour 30 minutes approximately, little more than that, 1 hour 40 minutes, which is not very bad for the first time. Earlier, we used to take 3 hours when the question used to be of 40 marks. Those questions were really complex. Those questions are still there on YouTube. You can find those recorded questions. And just as a practice, you can go through those answers and questions. So if you solve little complex more, then it's a bit easy for you to solve these kind of questions. We can take a break now. If you don't have any questions. Do you have any questions? You have written it down, everyone. Go through it. Unless and until you see the same question for at least twice, minimum twice, you will not be able to understand. After 2 times, you will feel somewhat, in sync with this kind of a concept which we spoke about. You know everything. You don't know how to apply it. That we had seen today. So this is what you have to apply it in the examination. Any questions you have?
So we don't need to pass the entries.
Why you need to pass the accounting entries? Why would you like to increase your work?
No, just asking.
No need to pass the accounting entries. If everything is given here, you are just, instead of passing an accounting entry, you are doing it here. So the acquisition accounting entry, whatever we used to pass that accounting entry, you have done it in this form.
Yes.
As simple as that. Okay. Leave enough space in between, because in examination utility, you will not be able to insert the rows. So even if there is a lot of space remain blank, let it be. Okay. So you will not be able to insert a line or something like that. Delete line, insert line. You can cut paste, but you cannot insert the line or delete the lines. Any questions? Okay. So we'll take a break. After a break, it's 1:40 right now. We will be back by 30 plus 20. Okay, around 2:30. We will be back, or a little bit earlier. Can you come a little earlier? So,
Yes, sir.
perfect. So we will come back by 2:20. 40 minutes break we will have. And after that, we will discuss the P&L problem. P&L problem is a little bit easier than, or little, squeezed one. We do not require that amount of time. And once we complete that P&L, we can stop for the batch entirely. Okay. So if you have any questions around any other questions with respect to the topics on a pen drive, you can check with me subsequently. Okay. All right. Let's meet at 2:20.
So,
Yes,
sir, will you share this Excel sheet with us?
I will do that. No problem.
Thank you, sir.
Would like to reduce your work?
Sir, actually, I was listening and I was seeing that, so I didn't type it over here.
That's okay. I will share this. Don't worry.